Okay, let's unpack this. What's really happening with Zaggle in the dynamic world of fintech? Welcome to the deep dive. We sift through the noise to bring you the essential insights. Today, we're digging into Zaggle Prepaid Ocean Services, a major fintech player. We're using their Q1 FY26 earnings call transcript as our guide, our mission, to pull out the really crucial bits for you, their business lines, growth plans, what they see coming down the track, and, the potential bumps in the road. Think of it as your fast track to getting informed about a company making some pretty interesting moves. And because it's from the transcript, you get that raw, unfiltered view from management and what investors are asking. So diving right in, what are the headline numbers from Q1 FY26? What's the immediate story?
Well, the immediate takeaway is pretty positive, actually. They reported really healthy revenue growth, hit INR 331
Yep,
crores.
331 crores. Okay.
Yeah, and importantly, it was their best ever Q1. That's a 31% jump year over year.
Strong start to their year then.
Definitely. And it's not just revenue. Their profit after tax, PPT, it surged, up 55% to INR 26 crores.
55%. Wow.
It is impressive. And underpinning this, you've got a solid base, over 3,500 customers across all sorts of industries, and 3.4 million users active on their cards and software.
Okay, so broad reach.
Exactly. And maybe the most telling number, their churn rate. It's below 1.5%.
That low, that really is striking. Speaks volumes about client trust, doesn't it?
It really does.
So what's behind that? How are they keeping clients so locked in? Is it just the tech or something more?
That's a great question. And it leads us straight into, well, how these numbers actually connect directly to the value Zaggle provides through its core platforms. If you look at the Q1 revenue breakdown, platform fees brought in INR 10 crores, program fees were INR 145 crores, that's up 15%, and then Propel points, they were the big driver, INR 176 crores, showing 50.6% growth.
Propel points leading the charge then.
Absolutely. And what's fascinating here is how these figures represent solutions to, real, often painful business problems. Yeah. That's where the loyalty comes from. Take Propel, for example. It tackles a huge headache for large companies, managing these complex, nationwide incentive programs.
Right, for sales teams or distributors, maybe?
Exactly. They gave this example a client trying to track performance and dole out rewards to over 60,000 retailers. 60,000.
Wow, manually that would be impossible.
Pretty much. And it was causing chaos, losing retailers, market share dropping. Propel came in, automated the whole thing, offered over 125 ways for people to redeem their rewards.
So a massive efficiency boost solves a direct operational nightmare. I can see how that builds trust.
Precisely. It's not just automation, it's transformation. And those kinds of gains feed right back into the strong financials we saw.
Makes sense. And it's not just Propel, right? You mentioned other platforms.
Correct. You also have Save and Zoya. These are focused on managing non-CapEx purchases, basically, the everyday operational spending, plus invoices and travel and expense reconciliation.
So streamlining the back office stuff.
Yeah. Use another client example. Totally manual processes for buying things, matching invoices, separate systems for T&E, just disconnected and inefficient. Save and Zoya brought it all together. One unified platform, complete visibility, control. Again, saving time, saving money.
Bringing order to chaos, essentially.
You could say that.
Yeah.
And then there's the Smart Employee Purchase Program. It's more of a innovative employee benefit, and they're building an ecosystem around it, partnering with Tata Capital for lending, One Assist for insurance, making it a richer offering for employees.
Okay, so expanding the value proposition there too.
And finally, Tax Planner. They're quite clear this isn't for everyone. It's not a mass market tool. It's sophisticated for employees with complex income, maybe foreign earnings, mutual funds, rent, crypto, you name it. For big corporate clients like Bosch, HCL, Accenture, it's about ensuring compliance in tricky situations.
So very targeted, high-value service for specific corporate needs.
Exactly. And this focus, this suite of distinct solutions tackling specific enterprise pain points, that's what drives the performance and keeps clients sticky.
Okay, so that organic growth engine seems well-oiled. But it sounds like they're not just relying on that, they're making bigger moves.
That's right. Here's where it gets really interesting. Because growth isn't just organic for Zaggle, it's about smart strategic moves, particularly M&A.
Acquisitions. Tell me more.
They're being quite aggressive, actively looking at investments or outright acquisitions in 6 companies. 2 are already done deals, 4 are in progress.
6 companies, that's ambitious.
Very. And the potential impact is huge. If these all go through, they expect to add something like 600 to 700 people.
Doubling their workforce,
Yeah,
basically.
more than doubling, yeah. It's a massive step up in scaling capability.
And are their past investments already paying off? Is there proof this strategy works for them?
There is, actually. They highlighted mobileware and earlier strategic investment. In Q1 FY26 alone, it generated INR 2 crores in profit before tax,
Okay.
which is more than its entire PBT for the whole of last fiscal year, FY25. So, yes, they seem to be good at picking targets and integrating them effectively.
That's a strong indicator. What about the current targets? What's the rationale?
Each one fits a specific piece of the puzzle. EPR Soft is about boosting their merchant servicing and payment processing side. Dicey is a big one. Described as a world-class product for spend management, strong AI capabilities. It brings in pure SaaS revenue, around INR 2022 crores this year.
And the acquisition multiple, did they mention that?
They did. Roughly a 6x multiple on forward-looking revenues. Gives you a sense of the valuation and growth expectation.
Right.
And the key opportunity Zaggle sees there is bundling their payment capabilities with Dicey's software. So selling payments alongside the SaaS subscription.
Cross-selling synergy. Makes sense.
Then there's Green Edge, that's to enhance their loyalty and rewards offering, bolstering an existing area. And Rio Money. This looks like a strategic play to enter the consumer credit card market.
Consumer credit. Interesting.
Yeah, leveraging their existing UPI ecosystem, India's big digital payment system, to potentially offer seamless credit options.
So these aren't random grabs. They're filling gaps, expanding into adjacencies, strengthening the core.
Yeah.
Very deliberate.
Exactly. Highly targeted. Deepening that all-in-one platform idea.
But growing this fast, especially through acquisition, must mean big changes internally, right? Beyond just more people.
Oh, absolutely. And they address this. Significant organizational shifts are happening. They're consolidating tech and engineering teams, bringing finance under one group CFO, centralizing HR. The goal is efficiency, better resource use.
Makes sense for integration.
And they actually put a number on it, and they expect these structural changes to save around INR 25 crores over the next year.
25 crores in savings just from restructuring. That's significant.
It is. And it shows they recognize, as you said earlier, that buying is one thing, integrating is the real work. It takes serious management focus.
Good that they're planning for it. What about partnerships? Are they doing anything there besides M&A?
Yes, a couple of key alliances too. One is a channel partnership with Grant Thornton, GT.
Okay, the consulting firm.
That's the one. The idea is GT promotes Zaggle's spend management tools to their large corporate client base.
Expanding reach through GT's network.
Precisely. And Zaggle keeps its margins because GT apparently makes money on the implementation services, not by taking a cut of Zaggle's software fees.
Smart structure.
Seems like it. And then there's a 7-year deal with MasterCard for premium co-branded prepaid cards focused on foreign currency. Includes incentives tied to launch and spending volume.
So leveraging established players to accelerate market presence.
Yeah, it's a multi-pronged growth strategy. Organic development, strategic M&A, and these smart partnerships.
It really does sound holistic. Let's switch gears slightly to product development, specifically AI. They seem keen on it, but not just for show.
That's the message they're putting out. Their philosophy, they say, isn't about chasing, the latest AI buzzword. It's about using AI to solve specific, real problems for enterprise clients.
Practical AI, what are some examples?
Well, they have a flagship conversational AI platform called Zaggle. That's for customer engagement across different channels. They're also launching a multilingual version of that soon, maybe in the next 3-4 months.
Right.
Plus, they've already rolled out an AI tool for automating bill processing. And they claim it's cut processing time by 80% or more.
80%, that's a huge efficiency gain.
Huge. And they're piloting another AI tool for claim validation and approvals. Again, targeting manual, time-consuming workflows.
So real focus on automation and efficiency through AI. Are they building this themselves?
Largely in-house, it seems. They mentioned investing about INR 40 crores in tech development last year, FY25.
Significant investment.
No, definitely. If we connect this to the bigger picture, Zaggle's AI approach seems less about flashy features and more about fundamental efficiency gains for their customers. Cost savings, less manual work, faster processes.
Which ties back nicely to the value proposition driving that low churn rate we talked about.
Exactly. It all feeds back into that.
So with this focus on practical AI and strategic growth, what's their overall feeling about the future? What's the industry outlook look like from their perspective?
They're extremely bullish, frankly. They gave strong growth guidance for this fiscal year, 35–40%.
35 to 40% growth for the year. That's confident.
Very. They even mentioned they were tempted to raise it higher, but decided to hold off until Q2, just given the broader geopolitical uncertainty and macro volatility out there.
Cautious optimism then.
Yeah, but they seem pretty confident they'll be able to up that guidance later.
Right.
And alongside this growth, there's a very clear focus on profitability, specifically improving AITA margins.
Right, the profit margin before interest, tax, and amortization.
Correct. They're aiming to increase that by 100 basis points. So 1 percentage point every year for the next 3 years.
1% margin improvement annually for 3 years on top of 35–40% growth. That's ambitious. How?
It's driven by a few things. Operational leverage, basically. Costs growing slower than revenue as they scale. Continued efforts on reducing other expenses, like those savings from restructuring, and also getting incentive costs down. They want those to settle around 50–60% of program fees in the long run.
So multiple levers for margin improvement.
Yes. And they're also being careful about global expansion. Very calibrated, they called it. Focusing on places with potentially higher profits, like the Middle East and the U.S. Sometimes they do this through small investments in VC funds in those regions. It gives them market insights, access to founders, potential partners, or targets.
Without the cost of setting up a big physical office right away. Smart way to test the waters.
Seems like it. Get exposure. Understand the dynamics first.
And competitively, how do they see themselves positioned? What's their edge?
Their core belief is their unique advantage lies in being the only player offering a truly comprehensive, enterprise-grade solution. One platform covering rewards, accounts payable, employee expenses, benefits, and handling prepaid cards, corporate credit cards, and UPI.
The all-in-one offering for enterprises.
That's their differentiator.
Yeah.
And their long-term vision. They think spend management is going to become a really established major category in the next decade.
And they want to lead it.
They aim to be its torchbearer, certainly in India.
Yeah.
So, yeah, very confident about the industry's future and their place in it.
Okay, a positive outlook overall, but we have to talk risks. Management themselves flagged acquisition integration as tough. Acquisitions are easy, but integrations are tough, I think you said.
They did acknowledge that, yes.
What are the specific hurdles there? Beyond just needing management time, are there worries about tech stacks clashing, different company cultures, maybe regulatory issues with combining businesses?
That really is the key challenge with such rapid M&A, isn't it? They didn't dive deep into specifics like tech stack conflicts on the call, but emphasizing the need for significant management bandwidth strongly suggests they know it's complex. The move to centralize functions like HR and tech is their direct response, trying to build that unified operating model and culture. It's definitely a major execution risk. Success here is critical to getting those synergies and savings they expect.
Absolutely. Integration risk is always huge.
And then there are the external risks they mentioned, those geopolitical uncertainties, macroeconomic volatility. That's why they held back on raising guidance immediately.
Right, the broader environment.
And just on a practical level, seasonality. Q1 is typically slower for program fees, which partly explains the slightly more moderate growth there this quarter compared to Propel points.
Okay, so internal execution risk on integration, external macro risks, and some seasonality. Got it. What about competition? You mentioned a specific query about Geo maybe entering tax planning.
Yes, that came up.
How did Zaggle respond to that? And what about the broader competitive threat? Can they really hold on to that all-in-one advantage against niche specialists or even big tech firms who might eye this space?
Well, this raises an important question about the long-term sustainability of scaling through rapid acquisition while trying to maintain that unique comprehensive position. On the Geo point specifically, Zaggle's answer was basically differentiation. They reiterated their tax planner isn't mass market like Geo might target. It's high-end, corporate-focused, handling complexity, foreign income, crypto, etc. for clients like Bosch, HCL. Specialized value, not volume.
So different target markets.
That was their argument. More broadly, while they claim no single competitor matches their full suite now, the threat often comes from, nimble startups becoming best in class in one specific area, or large banks improving their digital corporate offerings. Zaggle's strategy seems to be acquire those best-in-class niche solutions, integrate them, and keep building out the all-in-one platform that way, rather than try to build everything perfectly themselves from scratch.
So continuously acquire and integrate to stay ahead of specialized players. It's a challenging path.
Definitely requires ongoing, successful integration.
Okay. So what does this all mean for you? We've unpacked Zaggle's strong Q1 FY26 good revenue and profit growth, backed by a loyal client base. We've seen their ambitious growth plan, heavily reliant on acquiring and integrating other companies to build scale and efficiency alongside strategic partnerships. Their AI focus seems practical, aimed at real automation and value for customers, and their outlook is confident, targeting significant growth and steady margin improvement, even with external headwinds. But it leaves us with a key question. Considering Zaggle's deep commitment to improving those AITA margins through efficiency and AI, and their grand vision of leading the spend management category, how sustainable is their strategy of constantly acquiring adjacent businesses? Can they successfully integrate fast enough to truly maintain that unique all-in-one enterprise position against specialized competitors and potentially larger players entering the field in the long run? Something to think about as you watch the evolving fintech landscape.